From the past letters of Warren Buffett, there is something in common that we can see. He talks about the real profits of Berkshire Hathaway versus the profits which we can see on the income statement. This is because according to the accounting rules of 2017, the new rules, the real profits of Berkshire Hathaway are very different from those written on the income statement. And accounting rules differs from country to country. For example, in some countries, R&D is not considered an expense, but rather an investment. And then there are some people who will look at profits using different numbers. For example, I don't remember exactly which company it was. It was an oil company. I looked at it a few years ago, and they were looking at an adjusted EBITDA X as some sort of the real earnings of the company. But if we look at what I will call the real earnings of the company, they were doing poorly. But using that adjusted EBITDA X, it seemed that they were doing great. And even people who use EBITDA today, Warren Buffett tells these people who will account for capital expenditure, the two theory. So it seems that the definition of profits is different for most people. But as value investors, we need to look at what is the real profits. Because accounting, this is easy to manipulate, but we need to know the real profits of the company. And today we are going to talk about how to find the real profits of any company. I know that this is a video which is not going to be that popular, but this is what made me make so much money on GameStop. I always say that the short squeeze, it was secondary. The main reason why I made money on GameStop was because I saw that it was a sicker but stock. How did I see that? It was because I did not agree with what they had on their income statement. The profits they had there was not really what I calculated. So that's why it is important to know the real profits of a company. Before we dig deeper, we talk about that in more details. Please make sure to smash the like button for the YouTube algorithm. If you are new to the channel, my name is Ishfaaq. I am a popular investor on eToro, where I manage assets for over 1,500 people. So please subscribe and hit the notification bell so that you don't miss the coming videos. The most common types of profits that are reported in the news on CNBC is earnings per share, EPS, or net income. Net income is the profits of the company according to GAAP, the generally accepted accounting principles. And from net income to go to earnings per share, we divide by the total number of shares outstanding. But how do we get to this number, net income? First of all, the company, it has sales, revenues. And normally when the sales are going up, it means it is a good thing for the company. But here also you have to be careful because of accounting rules. For example, you look at McDonald's in recent years, their revenues are going down. But that doesn't mean that the company is doing poorly, because you can see that the profits of the company are increasing. So the reason why revenues are going down is because they are changing their business model. Now they are focusing more on franchises rather than focusing on their own business that they own. But the revenues of the franchises, which can be accounted as the revenues of the parent company, or only the profits paid by those franchises to the parent company. So that's why we can see revenues are going down, but profits are going up, which is a good thing because profits are more important than revenues. When we have the revenues of the company, next you will see that there is gross income. So the gross income, simply stated, is all the profits that comes after the cost of sales. If let's say I'm selling something, I sell Rubik's Cubes, I make and sell Rubik's Cube. The cost of one Rubik's Cube when I'm selling it is $100. It's an expensive Rubik's Cube. It's $100. But for me to sell that Rubik's Cube, it cost me, let's say, $10. What do I mean by selling this Rubik's Cube? The amount of money I have to pay my employees, the salesman who is going to sell this Rubik's Cube, the amount of money I have to pay for raw material for the Rubik's Cube, it's $10. So the gross profit of the company per Rubik's Cube is going to be $90. But this profit is not the real profit of the company because we did not look at expenses such as, let's say, rent. If you're renting a building to sell Rubik's Cube, it doesn't count as cost of sale, that expense, because it is not really necessary to sell the Rubik's Cube. Raw material is necessary. Paying the salesman is necessary, but paying the secretary is not really necessary because they are not really selling the product. So there are now new expenses such as research and development, SG&A, selling, general and administrative costs. all of these are called operating expenses. They are necessary to operate the company, the business. And after that, let's say from that Rubik's Cube example, we had $90 in gross income. If we have $20 in operating expense, finally, from 90 minus 20, you have $70 in operating income of the company. But this is before taxes, and sometimes it is called pre-tax earnings, but not always. Sometimes there are going to be other income expenses, which we are not going to go into details today. After that, we have the pre-tax income. Let's say for that company, the pre-tax income is $65. Now they have to pay taxes on that $65. Let's say it's 10%. So finally, how much money the company, the net income of the company is $59.50. So this is what is going to be written on the income statement, $69.50 per Rubik's Cube. If that company then, let's say, has 10 shares, the earnings per share of the company is going to be $5.95. The problem with calculating net income like this is, let's say, for example, Berkshire Hathaway, after the pre-tax income, there is a new income or sometimes expenses which is included. It's investment gains or losses. So let's say Warren Buffett, Berkshire Hathaway, they own Apple. If the stock price of Apple goes up, but they don't sell the shares of Apple, it's not really a profit for the company. It's unrealized profits. Only when you sell, then it is real profits. But on the income statement, according to GAAP, this should be included. That's why you will see that the income of Berkshire Hathaway, the net income, is very volatile because this is not really the real income of the company. Another problem is that it doesn't really show us the real cash of the business. Because let's say on the research and development expenses I had on my Rubik's Cube, they were patents. And the patents were being amortized every year. This is a non-cash expense. You only pay once to have the patent, but then you don't have to pay every year. But because of accounting rules, it has to be amortized every year. But in reality, it's not taking money out of the business. It's not taking cash out of the business. This is the same thing that happened with GameStop. When you look at the income statement, they were losing money. But when you do your research, the reason why they were losing money was because of impairment of goodwill. They acquired other companies, but because their market cap was falling so much, the company was heavily shorted, the market cap, the stock price of the company was going so down, they had to impair the goodwill. But in reality, the brand was still here. The brand that they bought was still here. So the only reason they had to do this impairment of goodwill was because of what Wall Street thought of the company. So it's not a real loss for the company. I will give you a third example with Enron, which made one of the largest financial fraud in history. They were manipulating their numbers. They were using something called mark-to-market. They were buying commodities and then they were trading those commodities. But when they were selling it, they were not selling it at the present price, but at future price. And of course, they could exaggerate the future price. So it was not a real profit. They were not really selling it as such. They said they were going to sell it in the future at a certain price, so it counts as a profit for them. But it's not real, it's not cash. All the profits of Enron were mostly based on hopes and dreams and fraud. So that's why we have cash flow. Cash flow is better. We have operating cash flow. Operating cash flow, it takes into consideration all those non-cash expenses. For example, amortization, depreciation, and also compensation to employees, non-cash compensation, that is stock compensation, are accounted for in the operating cash flow of the company. But after that, you have to subtract from the operating cash flow the capital expenditures. The capital expenditures is the amount of money necessary to keep the business in operation and also to grow the business. And finally, that number which you get is called the free cash flow of the company. This is, if you count actually how much cash the company is making, this is what you will get, the free cash flow of the company. But Warren Buffett goes a step further because he doesn't really believe that it is necessary to consider the cash being reinvested for growth. He focuses on the cash being invested to keep current operations because growth, we don't know how it will happen. This is just experimentation. We don't know if growth will actually happen. Maybe the new growth ventures they're doing, the business is doing, is going to fail. But if we can focus on what is real, we can focus on the real business in current operations. So that's why Warren Buffett tells us there are two types of CapEx, capital expenditure, operating CapEx, and growth CapEx. And when he calculates the owner's earnings, which is his version of free cash flow, he only subtracts the maintenance CapEx from the operating cash flow of the company. And also he doesn't really like to take into consideration the stock-based compensation, because this is, when we call it owner's earnings, is because it is earnings for us owners. But when we look at the stock compensation, this is compensation for employees, not really for us, so it should not be accounted for. The reason why owner's earnings make sense is because when, as a shareholder, you're buying shares of the company, as an investor in the company, you are an owner of the company. So you expect how much money, how much cash the company is going to return directly to you. The owner's earnings, in other words, is the amount of cash that the company can return to you, the maximum amount of cash. But they can use that cash in three ways. They can use it to grow the company, that is growth CapEx, reinvest in the company, in other words. They can use it to pay dividends to you, or they can use it to buy back shares. So there are three options for them. But all three options eventually is going to be for you, for the owner. Of course, they can also use that money to repay the debt. And why then we don't say that the owner's earnings is of the debt? It's because when they're repaying the debt, they are also lowering the liabilities of the company. So in other words, in the future, it's going to be in your favor. Even if in the short term, that money is going to be used to pay the bondholders first. If you want the whole details about all of this, how to calculate the owner's earnings of a company, I have talked about it in my course for beginners, investing course for beginners, and also in my research partnership. I'm going to talk about an example today, UNFI, a company I'm investing in. You can find a whole analysis on my research partnership about UNFI, how I calculated the owner's earnings. What is important and interesting about UNFI is that if you're going to read security analysis of Benjamin Graham, you will see that he tells us that non-recurring expenses or even profits should not be accounted as the owner's earnings. It makes sense, because if you think about it, you have a business, they are selling part of their business, they make money. This is a non-recurring profit for them. You should not account this for owner's earnings. It's only once. It's not going to happen every year. So don't count this. But for UNFI, I counted it. Here's the reason why. UNFI, they bought another company a few years ago with debt. Now there is a part of that company which they bought, they are selling it. And when they are selling it, they are using that cash to repay the debt. So in some ways, you may look at it as if they never bought that business which they are now selling, because they are using the cash to repay everything, the debt. So it's as if they did not really buy it. So I believe, I don't know if Warren Buffett or Benjamin Graham will agree with me, I don't know. But from how I see this company, I think we can account for these divestitures, I think selling of those business, as owner's earnings, even though we cannot really count them as free cash flow. That's why it is important, I believe, to look at every company separately. Each company is different. There are these online calculators. I'm not telling you not to use them. You can use them. But if you want to be an enterprising investor, if you want to make average returns above the market, above average, let's say the average returns for the stock market is 10%, you want to make 12%, you can use an online calculator. But now if you want to make 20%, you want to make the types of returns I made on GameStop, then I think you will need to build your own calculator for each company, because each company, this is a different business. When you're investing in a stock, you are an owner of the company now. So act as if you are an owner. Look at the real data, the real numbers, and calculate them. Don't just use some calculator someone else built for you. It's not going to work like that. Think like a business owner. Think like a capitalist. So let me know in the comments if you have any questions about that. I know it is not really such a simple topic to talk about. Thank you for watching this video. Please like, subscribe, and share. Please watch these two videos here if you have missed them. Have a nice day and goodbye.